Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Let's look back at March and see exactly what the big movers have been across the likes of the indices, the FX and the commodities space. And I want to look back at exactly who have been the big winners, big losers, and whether that could provide an opportunity to continue on that trend or to reverse that trend as we move into April. We're going to kick off first and foremost with the indices space. I'm going to bring up a chart that shows you a wide range of indices that we cover here at Scope Markets. Key amongst those has been the IBEX, or the Spanish index, Spain 35, essentially, up around 11% over the course of March. Certainly, this does appear to be, to a large extent, a catch-up play, but there's question marks around whether we see valuation or value coming into play for European indices as a whole. Of course, US markets have done so well off the back of that tech strength. But the question mark here is it time, now that we're starting to see those green shoots of economic recovery in Europe, and as we approach the likely June rate cuts from the Bank of England and the ECB, is it time for people to be looking towards Europe with greater favor, given the fact that there's big question marks over whether the Federal Reserve are going to be able to cut in June alongside their European counterparts? This is the chart for the IBEX. This is the weekly time frame, so it shows you just how dramatic those gains have been of late, coming off the back of this period of consolidation that dominated the back end of last year, coming into the first couple of months of this year. And then March was really the time that we saw it fly. There's question marks as to whether this is overextended, quite frankly. I wouldn't necessarily want to chase this in terms of just blindly looking to go long of this market, because I am hesitant about the possibility of a pullback before too long. That being said, like I said, there is still room for maneuver when it comes to sort of relative valuations looking against the US markets. If you look at areas of resistance, you can see that we're coming back into this area where we have previously peaked out in the past, most notably this 111.92 resistance level. So could that once again force this market lower and see us enter a phase of consolidation? Well, we've certainly kicked off the new month on a little bit more of a downbeat tone. Have we broken out of the near-term trend? Well, I'm just trying to drive down into these shorter time frames to really gauge exactly what that trend looks like. So the hourly time frame we have here, we can see very clearly this ascending trend line that has now been broken. So that points towards a possibility of a bit of a pullback coming into play. In terms of near-term swing lows, you'd probably be looking down here, which is a way away, which is 108.39. But above that, you can see sort of smaller moves as well. The nearest of which is 109.70. So given the fact that we've broken through trendline support, we're now trying to find that as newfound resistance. A breakdown through 109.70 in particular would start to tell a story around a possibility that we see this market start to roll over and weaken from here. But certainly we've seen a bit of a pullback. We haven't taken out any of the near-term swing lows quite yet. So as long as we're above that 109.70, then the trend still does continue to play out. But I would say that there's some hesitation, just given how far it's run, and also the fact that we've broken down through that trendline support. On the bottom end of things from the indices space is the Hang Seng, so Hong Kong 50 essentially. And you can see that essentially hasn't really gone anywhere over the course of March. But nonetheless, that is belying a trend that has been relatively favorable, really. And I feel like the weakness that we've seen over the course of March is more just a case of exactly where the beginning and the end of the month lays, right? Because the trend has been relatively bullish over recent months, but we saw that pullback coming into fruition towards the latter part of the month. And now we've actually kicked off the new month of April on a positive footing. And you can see here that by and large, the trend that we've been seeing since these lows in mid to late January has been a bullish one, where we're seeing the continued setting of higher highs and higher lows. And if you follow me regularly, you'll know that I'm very keen advocate for Fibonacci. So all of these moves have generally been sort of mid to deep retracements. Then this latest move has come into a nice deep retracement as well. Let's just I've only got the 61.8 on this one, so it's not necessarily showing it perfectly. So there you go, absolutely perfectly onto the 76.4 Fibonacci level. This looks like a 50% move. Then we've got the move in the middle here, which looks like it's probably going to be a 76.4 Fibonacci level once again. So look, we've seen this pullback in towards the back end of the month, and it looks like we're likely to head up through this prior resistance level around about 172, sort of 170, 196. So the bullish trend that has been playing out over recent months does still remain in play. March gave us that pullback perfectly into the 76.4 fib. We've touched it on a few occasions, and now we're pushing higher. And actually, over the course of the weekend, we did see PMI data coming out of China, which was very favorable. We saw manufacturing back into expansion territory. So things appear to be turning in favor of the bulls from the sort of Chinese perspective. It comes off the back of a really bad time when it comes to people holding shares in Chinese stocks, and of course, the highly correlated Seng or Hong Kong stocks. And therefore, as things stand, we're just trying to regain a footing within a very bearish trend. But I would say, given the fact that things are starting to turn on the economic front, this move higher of late has been notable. Look out for this 171.84 as your near-term resistance level. We tagged it recently, pulled back into that 76.4 fib. We're now pushing higher once again. If we can break through that level and up through trendline resistance, we could be looking at a very advantageous position for the bulls as it tries to sort of find its feet following a very difficult couple of years for this index. In terms of the FX space, we can see here that the outperformer has been the greenback, and that really has come as we see this sort of realignment away from this idea of 7 rate cuts this year, starting in March. That obviously didn't happen. Instead, we're now looking at 3 rate cuts from June. I think there's a good chance we could see even less than that, quite frankly. So that provides the basis for some upside for the US dollar. I wanted to show you this chart. Hopefully it's clear on your screen, depending on whether you're using a phone or a laptop. But let me just try and zoom in. So this is the US dollar against a handful of the major currencies. So you can sort of see if you're looking for strength for the US dollar, continued strength, then you can look across this and say, okay, where does that setup fit best? I mean, you can see here that we're trying to see another rebound for dollar CAD following a protracted move towards the upside, but the CAD actually has been coming in for some strength. You can see here the US dollar against the Swiss franc looks particularly attractive given the gains that we've seen of late, and we're trying to push into resistance once again here. But certainly the US dollar has been a big benefactor, and I think there's potentially a little bit of juice left in the lemon because of the idea that we could see the Federal Reserve pass on a rate cut once again in June. And if that is to happen, then of course it means they're going to have to prepare markets for that eventuality. So certainly if we're looking towards that to happen and the possibility that the Federal Reserve might choose to maybe even do less than 3 rate cuts this year, that could give another little bit of upside for the US dollar. I just wanted to give you a view here in terms of the dollar index as a whole. We can see here pulling back as we start this new month, but arguably things have been very strong for this market as it takes back some of the losses that we saw at the back end of last year. Crucially, come into this resistance level that at the moment seems to be being respected, 104.976. But certainly the trend for the time being still remains bullish for the US dollar. And then another market I wanted to show you, here we go, is the Swiss franc. So you can see here the Swissy at the bottom of the stack, and that comes off the back of the Swiss National Bank deciding to cut interest rates, the first of the major banks. And we can see here across the board, we've seen Swissy weakness. That has a strong possibility of continuing apace. And certainly if you're looking at countries that could possibly be more hesitant, or central banks that are going to be more hesitant in terms of their policy, then the Swiss franc looks like the kind of currency people might want to target in terms of the short side of that trade, because of the fact that they're already moving in that direction and are expected to continue to do so. So potential weakness for the Swiss franc. And again, if you're looking for potential strength, the US dollar has been doing particularly well, and therefore it comes back to that dollar Swissy trade that we're seeing previously. You can see on the weekly time frame, it's been a protracted period of upside for this market. I think there's a good chance that we still do see this play out, and ultimately, as they say, the trend is your friend until the end, and the trend is still in play as things stand. A breakdown through this essentially 0.9 mark would be needed to negate the bullish trend here for the dollar against the Swiss franc. And finally, we have the commodities space, and commodities has been dominated certainly of late by precious metals, with the likes of gold and silver also starting off the new month of April on the front foot. But certainly it's been a relatively good month for them thus far anyway, in terms of March. Strength coming into play as we prepare for the potential monetary policy easing being implemented from the likes of the ECB and the Bank of England, at least in June, possibly the Federal Reserve. And certainly, you know, if I look at, say, silver, which has been the big outperformer, what we can see here is if we plot the price of silver against the Fed funds rate, we can see that previous occasions where interest rates are cut, that often kicks off a period of strength for this market. Now, when we're seeing interest rates being raised, that's not necessarily beneficial. So we've seen interest rates being raised, we're in consolidation mode. We've seen the same here, consolidation mode. But when you see this market, when you see interest rates being cut, that often kicks off that next bull run for silver and gold. And so silver, of course, when we see precious metals perform well, generally it's silver that outperforms gold. But then when we see this area doing poorly, then generally it's silver that loses the most. So it's the most volatile of the two. The gains that we've seen of late come into a interesting area, that's for sure, because essentially we've seen this zone sort of 25.9 to 6.1. That zone has essentially really capped previous gains, and we can see that this trend of lower highs really do rest on the idea that we're going to remain below that level. I think there's a good chance we break it this time around, and that could really see us catapult this market onwards and upwards to push up into the prior high that we have here at 30.1 essentially. So we could be setting up for a protracted period of upside for silver, and by that metric also gold. I think ultimately the environment for interest rate cuts taking place over the course of this coming year do provide the basis for strength for precious metals. It's one of my main sort of themes that I've been looking at coming into this year, and have been looking at it for some time, because usually when we see interest rate cuts, we don't necessarily expect it. It might happen because there's an economic crash and suddenly the central bank has to react. This time around, it's been telegraphed well in advance. As soon as they're raising rates, we knew they were going to have to cut them down the line. And generally, when interest rates are cut, that is beneficial for precious metals. So we're starting to see that. And certainly, you know, people trading silver and gold over the past month might think, you know, I've done great. But ultimately, I think this could be just the beginning as we head into a period where we finally see monetary policy reversed in favor of the likes of gold and silver, and possibly to the detriment of the US dollar once we get going. And on the bottom end of this, we have natural gas. We've actually seen plenty of volatility over the course of the month. And certainly we essentially have exited the period where generally natural gas gets utilized the most, the winter period. And that's when the drawdowns occur. And, you know, the whole Ukraine-Russia thing that in the past saw prices spike, that has essentially been overcome. It doesn't look like we're going to get back towards those levels again. And instead, we've seen Europe really push as hard as they can to fill every bit of inventory with gas. So that sort of supply issue appears to have gone away. And instead, we're seeing oversupply, with the fact that US is seeing record production of oil and gas. Well, oil, and by that metric, they also produce a lot of gas. So at the moment, there's plenty of gas, and that has come to the detriment of natural gas prices. We've seen a pop at the beginning of this new month, and that by and large also has a reflection on the fact that We're seeing commodities do well with the Chinese PMI data and manufacturing PMI data as a whole doing well. But certainly, I think this isn't necessarily a market I'll be looking to buy into right now, despite the fact that we have seen that rise up through your resistance level here on the near term of 187.6. Towards the upside above that, you're going to be looking at 2056. But certainly, maybe this has bottomed, but the trend is overwhelmingly bearish. And so, I think maybe we're just in for some volatility. Certainly, if you look from a historical perspective, we're back down to levels that were very cheap in the past. So I'm not necessarily looking to short this massively, but I'm also not necessarily looking to, as they would say, catch a falling knife. It's not necessarily a falling knife anymore. We have seen some consolidation, but certainly it's still a market that's likely to see plenty of volatility, but there's big question marks given the supply and demand picture around this market.